Hi, this is Chris German. Welcome back to the Apartment Dealer Show. Today, we're going to walk through 2023, the first quarter, multifamily sales. What did it mean to investors in terms of sales volume, sales prices, rental rates, vacancy rates, and all the rest? Stay tuned to find out more. Hi, this is Chris German. Welcome back to the Apartment Dealer Show. On today's show, we're going to walk through the first quarter of 2023. It's in the books. What happened in the world of multifamily here specifically in Los Angeles, San Bernardino, and Riverside counties. Now, as we go through the data, the first point I want to make here is that this data comes from a third-party CoStar analytics. So it's not my baked version of the data trying to construe some determined endpoint. This data, again, comes from an independent third party. Their sole purpose of existing is to sell that data to brokers like me, so they don't have a vested interest whether you buy, sell, hold, or anything in between. So again, just to note, these analytics are from a third-party source. Now, of course, these counties are large, so we break the data down into individual corridors. I've pieced these corridors together and have been doing it this way for some time because the rental rates, tenant base, and values are about the same of the cities that we group together. So let's go through these individual corridors. When it comes to the East Los Angeles corridor, we're talking about Boyle Heights, East LA, and El Sereno. When it comes to the 710-91 corridor, this consists of Bell Gardens, Commerce, Cudahy, Huntington Park, Maywood, Paramount, and Southgate. The West San Gabriel Valley, Alhambra, Arcadia, Monterey Park, Rosemead, San Gabriel, Temple City. East San Gabriel Valley, Azusa, Baldwin Park, Covina, El Monte, Glendora, Laverne, Monrovia, South El Monte, West Covina. The 605 corridor, Bellflower, Downey, La Habra, La Mirada, La Puente, Lakewood, Montebello, Norwalk, Paramount, Pico Rivera, and Whittier. The Inland Empire West, Chino, Claremont, Montclair, Ontario, Pomona, Rancho Cucamonga, and Upland. Inland Empire East, Bloomington, Colton, Fontana, Rialto, and in Riverside County, we're only going to be taking a look at Riverside City proper. Now, before we dig into the analytics themselves, I want to share some footage with you from our most recent Apartment Owners Educational Luncheon. At this event, we take a much deeper dive in terms of the strategy. Okay, the analytics say one thing, but based upon that, what type of investment strategy can you build from there? Or you can use that information to then decide you're going to do X. At that live event, I opened up with taking a look at, let's take a look at the decade, essentially between 2000 and 2010, and then take a look at 2010 to current. Could we find any similarities in the ebbs and flows of the market? What could the last decade, especially the last 3 years, tell us in terms of the trajectory of the multifamily market? It's very, very telling. Let's look at that footage now. We just experienced, or are still experiencing till I guess a couple of days from now, the slowest quarter in multifamily sales in more than a decade. Primarily, you can point that to the fact that interest rates have increased significantly over the course of the last year and a half. Okay, so how does that translate to our market? So let's take a look at East Los Angeles. The graph you're looking at now, the bar graph depicts total sales volume. If you added up all the multifamily properties that sold in that year in this particular geographic location, that's how much sales volume. The line graph is value, prices, the actual prices, okay? Now don't get too caught up, just follow the major theme here. So this is from 2003 to 2012. Of course, we had a great market, 5, 6, 7. The lull of the market, the bottom of the market, 2010. Then we began to climb based upon fundamentals. Vacancies were decreasing, no more concessions, rental rates were rising. And about 2019, the market starts eclipsing the hill. But then all of a sudden, we get a catalyst in 2020. And that's important to know as we go forward. Now, 2022 looks like not so bad of a year until you take a look at, well, let's take a look at what happened the last half of the year. Sales volume drops significantly. How about if we jump over the 710-91 corridor? Bottom of the market, 2010, we start to climb based upon fundamentals. Vacancies were decreasing, rental rates were rising. 2019, we began to eclipse this hill. And then all of a sudden, we get a catalyst from 2020. We take a look at last year, sales volume plummets in the fourth quarter. Interest rates had really taken a hold of the market. Pasadena, low of the market, 2010, we start to climb. Then things start getting choppy around 2019. Anyone following a common thread here? But then we get a catalyst, a saving grace to the market. And then you can see sales volume fourth quarter in 2022 drops significantly. Western San Gabriel Valley, we start to climb starting in 2009. Things begin to change in 2018. Remember, bar graph, that's prices begin to decline. Sales volume is off. Then all of a sudden out of 2020, we get a catalyst. The fourth quarter, significant difference from the beginning of the year when we look at the Western San Gabriel Valley. So we can do this all day. Eastern San Gabriel Valley, it's the same thing. You look at the fourth quarter in 2022, interest rates. 605 corridor, we start climbing from 2009. We gets rocky in 2019, but then we get a catalyst in 2020. Okay. 2019, October, we're here in this room. Now this data, I should have mentioned, comes from CoStar Group. CoStar Group is a third-party entity that has nothing to do with me. All they do is sell data to brokers like myself. They don't care if you buy, sell, hold. They don't even care if you own multifamily. They get paid on the data, but they're the best at what they do. That's why we use their data. Just so you understand, this is not a setup and some type of sideshow in terms of when we're looking at the analytics. This is the reality. Well, what happened in 2020? Other than being told to get locked up in our homes and running out of toilet paper, what happened? A huge injection of cash hit the market that never was supposed to exist. People were told to work from home and move from the cities to the suburbs. Rental rates took off like a rocket and interest rates were cut. Perfect storm for a market that was already teeter-tottering. Let's go to 605 corridor, fourth quarter, right? Same thing. Now, if we jump over to Empire West, different story. The Inland Empire was the recipient of people saying, you know what? I'm being told to work from home. I'd like to have more space, affordability, and people fled LA in general and headed east. So it's been a little bit different in the Inland Empire. But the catalyst in 2020 was low interest rates, funny money, and rental rates that saw historic gains. And this is Inland Empire East. Since about 2010, we've been encouraging our personal clients, and if you came to these events, consider the Inland Empire. We're seeing a huge growth in rental rates. You're going to see right behind that a huge growth in value. And those that purchased in the Inland Empire, like myself and my partner Deepan and several of our clients, have done very well in terms of cash flow and what have you. What's the takeaway? What's the punchline? 2019, the market was already adjusting. Then in 2020, we got a savior of sorts where we got this injection of cash, low interest rates, and that put the multifamily market reablaze once more. But now that interest rates have increased and rental rates are slowing, vacancies increasing, we're losing our two saving graces. Hence the slight pressure that you see currently on multifamily values, and us kind of returning to more normal interest rates has changed the market to fluctuate from where we were from our recent highs. But you shouldn't be down about this. This should have been expected. For us to think that interest rates for loans was going to stay at 3.5% forever, that just wasn't logical. And for us to get back to 3.5% interest rates, because there may be some of you watching this saying, hey, I'm going to stay out of the market. Now that the interest rate is closer to about 5.5, 5.75, I'm out of the market until I see 3.5 again. What's the likelihood that we're going to see that? Keep in mind, in order to get that interest rate, it took a pandemic. It took a global catastrophe in order to get the interest rates that low. What would cause it to go that low again? Again, I'm not an economist. I'm just saying, I think that if you take yourself fully out of the market in hopes that you're going to see those interest rates, you might be waiting some time and stepping over dollars to pick up pennies because of the deals, the transactions that you could have done along the way. Okay, let's dive into the analytics. Let's start with the East Los Angeles corridor. Total sales volume for the first quarter, January to the end of March 2023, was $5,235,000. The average price per unit, $248,000. The average cap rate, 4.16%. Now I want to stop here for just a second. Keep in mind, in East Los Angeles, you're talking about, this is an unincorporated area of Los Angeles County, meaning they have their own rent control. And for about the last 3 years, you were not able to raise your rents, not $1. So if you did raise your rents and you own in unincorporated Los Angeles County the last 3 years, you might want to take a look at that. You would have done so illegally per their local rent control ordinance. But now that that's been lifted and they say, yes, you can raise your rental rates, guess what? You can raise them a whopping 3%. So any of the neighboring cities, Montebello, Maywood, up and down the 605, 710 freeways, you could raise the rents basically triple that because the ceiling is 10% outside of a couple cities that have their individual ordinances. But just keep in mind that this is something that's in place in the East Los Angeles area. The average GRM, 17.69, cap rate and GRM. I get the question enough. Well, how do you calculate these? What do they mean to the value of a property? Let's discuss cap rate first. So an easy way to understand cap rate is if you were to buy a building all cash, what would be your expected rate of return? That's an easy way to understand cap rate. Well, how do you calculate it? You take the net operating income of a property, okay, take the annual gross income and minus out taxes, insurance, utilities, repairs and maintenance, and all the rest. That gives you your net operating income. Take that number, divide it by the purchase price. That will give you your cap rate. GRM, gross rent multiplier, take the annual income and how many times do you have to multiply that to equal the purchase price? So we have cap rate, GRM. Why are these important? Well, if you're looking at potentially purchasing a property and you're looking at 3, 4, 5 different properties, they're all different sizes. They have all different bedroom, bathroom counts. Well, how do you compare one to the other? Cap rate and GRM will tell you how those properties are performing, specifically with respect to the asking price of a particular property. And as a property is being evaluated, this is what we look to, right? The income. How is the property performing? We lean heavily on cap rate, GRM. Probably second to those then becomes price per unit, price per square foot. Really, value is a cross-cut of those 4 metrics: cap rate, GRM, price per unit, price per square foot. You take a cross-cut, cross-section, if you will, of those 4 to determine the value of a property. Square foot, the average price per square foot for those properties that sold the last quarter, $363. Now, how many buildings are in this corridor? Only 690 buildings. So there's not, now, that's 5 to 50 unit buildings. Of course, there's fourplexes and triplexes and duplexes. We're talking commercial real estate, which again, upon the 5th unit and larger, that becomes the commercial segment of the market versus the residential segment of the market, which is 2 to 4 units. So of 5 unit to 50 unit buildings, there's 690 of those in this local corridor. How many sales total were there? That was 4 for the averages that we took a look at. Now let's discuss rental rates. You can pause the video here so you can get a good look at our graph. But what my staff and I have done is we have gone to Zillow, Rent-A-Meter, CoStar, brought the averages together for those rental units that were rented and on the market open for rent to find you what are the averages in your area. For example, El Sereno, a one bedroom, $15.99. Now, would you necessarily go on a listing service and see a one bedroom listed for rent for $15.99? No, these are averages just to give you some sense of where the market is. We're going to list here the rental rates for all the corridors, but to make things even easier, to make life easier for you, a month ago, we launched a website, my company, we launched a website, raisemyrents.com. My promise to you is if you go there as often as you like, we're going to update the rental rates once per quarter. Again, pulling the averages from those sites that are most prevalent in carrying the rental rates. Right now, it's Rent-A-Meter, Zillow, and CoStar. Maybe a year from now, it's another website that becomes more dominant. For now, it's what we rely on. But bottom line is if you go to raisemyrents.com, you'll find the information there. It's free. My gift to you. Why? Because I want you to raise your rental rates. Nothing impacts the value of your property more than the income that it collects. This is very, very important. Tell all your friends, raisemyrents.com. It's free. All the info is there. Let's talk about the highest sale within the first quarter. Well, that was a 5-unit building in East Los Angeles, 90022 zip code. Sold for $1,460,000. That's $292,000 per unit. Now, this property was on Via Corona, so it wouldn't, in my opinion, be East LA proper. This gets you closer to the Montebello border. That definitely impacts value because $292,000 per unit is not characteristic of, say, something that's closer to Whittier Boulevard and the 710 freeway. But nonetheless, it falls within the zip code. That was your highest sale for the first quarter this year. 710-91 corridor. Now, how many buildings are in this corridor? 2,467. How many sales were there? 3 sales for the first quarter. The total sales volume for the first quarter of this year amounted to $13,708,000. The average price per unit of those 3 buildings that sold was $252,139. The average cap rate, 4.56%. And our last metric here, price per square foot, the average of those that sold, $350. Rental rates. Again, you can stop the video here. We have them here listed for you. Maywood, Commerce, Southgate, Bell Gardens, Cudahy, Huntington Park. Who loves you? The apartment dealer loves you because we did all the research for you. But you can find your city of interest, the bedroom count, it's there for you, or again, raisemyrents.com. The highest sale in this particular corridor, first quarter of 2023, was this 40-unit property in the city of Bell. Sold for $10,200,000. That's $255,000 per unit. And that property was there on Flora. West San Gabriel Valley. Now, in the first quarter of 2023, there was 9 total sales. Available properties, 1,926 properties. So this particular corridor has a lot of multifamily properties that are between that 5 to 50 unit range. Total sales volume, $48,100,000. Average price per unit, $333,772 per unit. The average cap rate, 4.28%. And the GRM, 14.89. Average price per square foot, $373. Our rental rates for the West San Gabriel Valley. You can pause here, find your bedroom count, your city. It's all laid out for you there. Now, our highest sale in this particular corridor was this 18-unit property in the city of Arcadia over on Arcadia Avenue. Sold for $8.8 million. That's $488,000, almost $489,000 per unit. Big price tag for this particular property. The East San Gabriel Valley. In the first quarter 2023, we had a whopping 2 sales. And the total building count is 1,871, another good sized corridor for a number of properties. The total sales volume was nearly $5 million, $4,967,000 in total sales. Average price per unit, $270,439. And the cap rate in the Eastern San Gabriel Valley for the first quarter 2023, 4.65%. The average GRM, 14.61, and the average price per square foot, $254. As we look at our rental rates, for example, you take a look at Covina, a 1-bedroom average is $1,814. Azusa, 2-bedroom, $2,228. You pick your city, you pick your bedroom count, the data is all there. And the highest sale for the Eastern San Gabriel Valley first quarter 2023 was this 10-unit property in the city of Glendora, $3.2 million, sold for $320,000 per unit. And that property there was on Lamar Park. The 605 corridor. Now, in this particular corridor, decent amount of sales, 17 sales for the first quarter. That is from a total building count, total stock of 3,225 properties. The total sales volume was $59,563,000. The average price per unit, $292,743. The average cap rate, 3.74%. The average GRM, 15.57. Average square foot, $368 per foot. In terms of your rental rates here in the 605 corridor, and again, because we're talking about a lot of cities that have been grouped together, there's some variation here, but we have each individual city listed for you. Each of the bedroom counts very user-friendly for you there. What's the idea here? Raise your rents to the appropriate levels. It impacts you today financially, long-term with your equity. In the 605 corridor, highest sale in the first quarter was this particular property on Cheshire. Now, a little bit of cheating here. This is obviously a newer constructed building, right? Well, we see something sell for $500,000 per unit in this particular corridor, but nonetheless, we had to share the data because this was in fact a sale. 6 units sold for $3,035,000, and that's again $505,000 per unit. The Inland Empire West. Now, total stock is about 1,123 properties. Of those, there was 12 sales. The total sales volume, $37,640,000. The average price per unit, $269,640. The average cap rate, 4.4%. Average GRM, 13.43. The average price per square foot, $286. The rental rates in the Inland Empire West, and of course, the Inland Empire West was the recipient of a lot of tenants over the last couple of years as people headed east for affordability, more room size, and what have you, as you've heard us discuss in previous videos. You'd be really surprised what the rental rates here are in the Inland Empire. I'm currently doing a fix and flip project of a multifamily property here myself, and we were quite astonished at the final rental rates for 2-bedroom, 1 bath, getting about $2,300. Once upon a time, you couldn't have imagined that type of rental rate in the Inland Empire. But again, the rents have risen dramatically. Here they are listed for you now. The highest price sale in the Inland Empire West was this 48-unit property in the city of Pomona over on Falcon Street. 48 units for $14,500, a little over $300,000 per unit. Pretty hefty price tag for the Inland Empire. Now, the Inland Empire East. Total stock is 287 buildings. Not a lot of stock here. There was 1 sale, so you can understand why was there only 1 sale. Not a lot of stock to begin with, but doesn't mean it's not a great area to own in. Even myself, I have a couple properties out this way. You'd be surprised at the trajectory of values, the trajectory of rental rates. So just not a lot to buy though. Sales volume, 736,000. So we can about guess the price tag of the property that sold if there was only 1 sale. Price per unit, $147,380. Cap rate, 5.41. GRM, 15.65. Price per square foot, $188. The rental rates here in the Inland Empire East are all laid out for you here. Feel free to pause the video, or again, you can always head over to raisemyrents.com. And that particular property that sold was this property here in Colton, 5 units on West C Street, sold for $736,900. And that's your most recent sale here in the Inland Empire East. Now, the city of Riverside. Total stock, 414 buildings. And in the first quarter, 2023, we had 1 sale. 1 sale for the entire city. That sale was $4.5 million, which was $142,000 per unit. Extremely low cap rate of 2%. So I think that has much to do with the final sales price at $142,000, because that's definitely on the lower end of the spectrum. That's not very common for the city of Riverside in terms of a price per unit. It's higher than that. But look at the price per square foot, $432 a foot. That is, those units were smaller size. Anytime you make the leap over $400 a foot, that tells you, it's very telling that the unit size was on the smaller side. With respect to rental rates here in the city of Riverside, studios are about $1,438, 1 bed, $1,656, 2 beds, $1,941, 3 beds, $2,474. Those are your averages for the city of Riverside. And this is that property that sold over on Tyler, 32 units, $4,550,000. Again, $142,000 per unit. Let's discuss vacancy rates and rental growth rate. Why? Because at the opening of the segment, I outlined for you why the two saving graces to our market and why we didn't see a greater adjustment than we've seen and why we didn't see it earlier was because of interest rates and rental rates. Well, if vacancy is increasing, typically that will put downward pressure on the rental rate. So we're going to see what's played out here in the various corridors. Now, these analytics come directly from CoStar. So their corridors are different than mine. So we're going to re-outline for you what cities they're discussing as we jump through their corridors. So their first corridor, their first segment of the map, they call the Southeast Los Angeles multifamily submarket. Within this submarket, we have Bell Gardens, Boyle Heights, Commerce, Downey, East Los Angeles, El Sereno, Huntington Park, La Mirada, Maywood, Montebello, Pico Rivera, Southgate, and Whittier. And what do we have? In 2022, the average vacancy rate across the spectrum of those cities was 2.2%. The vacancy rate as of the first quarter 2023 has risen to 2.9%. The annual growth rate for the last 12 months has been 3.4%. So what does this all tell us? Well, if vacancies in fact are increasing, then that does create that downward pressure that I mentioned on the rental growth rate, which we see, and as of now, it's slowing. Of course, we're only into the first quarter of the year, so we're going to watch this over the coming months. Does this continue to be the pattern? Now let's take a look at the other submarkets. The next submarket listed by CoStar is the South Los Angeles multifamily submarket. Of the cities we work, included in this submarket is Bellflower, Lakewood, Norwalk, and Paramount. What happened with respect to vacancy rate and rental growth rate? Well, in 2022, the vacancy rate was 1.9% on average across the cities for the entire year. As of the first quarter 2023, that has now risen to 2.8%, and the annual rental growth rate has slowed to 2.4%. So again, this is that common thread that we see. If we jump over to the San Gabriel Valley multifamily submarket, which consists of Alhambra, Arcadia, Azusa, Baldwin Park, Claremont, Covina, El Monte, Glendora, La Puente, Monrovia, Monterey Park, Pomona, Rosemead, San Gabriel, Temple City, and West Covina, what we see playing out is in 2022, the vacancy rate on average was about 2.1%. It has now grown in this first quarter of 2023 to 3.5%, and the annual rental growth rate has slowed down to 2.1%. It's the same thread that we've seen in the other market. Now, for our next submarket, as we head towards the Inland Empire, the Greater Ontario Rancho multifamily submarket, as they call it, consists of Chino, Montclair, Ontario, Rancho Cucamonga, and the city of Upland. In this submarket, what we find is that in 2022, the average vacancy rate was 2.9%. The vacancy rate now for the first quarter has leaped from about 3% now to 5.5%. And take a look at the annual rental growth rate. It actually has receded backwards to a negative 0.4%. Vacancies increase, always puts downward pressure on the rental rates to now where things have essentially, they're at best trailing sideways the rental rates from what we saw, say, from fourth quarter last year. Now for the Greater San Bernardino multifamily submarket, which consists of Bloomington, Colton, Fontana, Rialto, what do we have? The vacancy rate in 2022 was 2.6%. The vacancy rate here, the first quarter, has risen to 3.7%, and the annual rental growth rate has slowed to 3.5%. The Inland Empire saw the largest amount of rental growth rate over the course of 2020, 2021, and 2022, and now that's slowing just like the other submarkets. And for our last submarket here, Riverside, what is taking place in the city of Riverside? Well, in 2022, vacancy rate was 5.3%. The first quarter, it's risen from that level to 6.4%. And here we see that annual rental growth rates have actually pulled back negatively 0.1%. So again, about trailing sideways of what they were fourth quarter of 2022. So what can we surmise from all this data? Well, we start off the conversation understanding that the market was poised for a correction in 2019. Rental rates had grown since about 2010. Values had gone upwards from about 2010. And of course, markets have cycles. So had we cycled through starting in 2019, that would have been the end of the world. That would have been expected and anticipated. And the only reason why we did it is because in 2020, we got that catalyst of an injection of cash into the market, stimulus, and the retraction of the interest rates to hedge all the global economic chaos. Well, as we saw or know, interest rates now have gone from 3.5% to say 5.5%, and rental growth rate at best is still climbing at about 3.5%. And in some areas, as we saw, it actually has receded backwards to a negative position where actually the rental rates are slightly less than they were, say, last year. So is the market cycling? Again, we're only through one quarter of data. I'm willing to concede we need more data to really get a sense of, has the trajectory truly changed? Of course, we're going to stay on the pulse of the market for you. Now, what if you're in need of something more specific? You're looking to answer the question, Chris, what is my building worth? We're happy to assist in that way. We do these evaluations every day. When I step out of recording this video, I have 2 evaluations to review for clients as they're curious as to what are their properties worth today. Please contact us if you own a multifamily property that's in a city that we service, and we can put the map up here now. But essentially, my team services as far west as the 710 freeway, as far east as the 215, as far north as the 210 freeway, and as far south as the 91. So if you own within a city within that geographic area, we have the data, the know-how, and the analytics to assist you in that evaluation. One other thing that I'll mention before letting you go. Investors, multifamily investors, landlords, did you know that the IRS has announced a one-time extension for 1031 exchanges, specifically the identification period? When doing a 1031 exchange, what's normal is a 45-day identification window, meaning from the day that you close escrow on the property that you would be selling, the IRS gave you 45 days to then go out, shop, and find that property or properties that we're going to serve as your next building. And for many landlords, they felt like that 45-day window was so short. What if you got caught and couldn't find something to buy? Now, even within those timeframes, we never, not a once, have had a client not find the ideal replacement property to exchange. But I understand the hesitancy and the anxiousness when you hear 45 days, so I get it. Well, to address that, and not because of the anxiousness of landlords, but because the IRS actually said, hey, you know what? California had all these rains and flooding and what have you. We're going to deem it basically a disaster area, and we're going to allow California residents to, for those that are going to do a 1031 exchange, give them all the way up until October 16th of 2023 to identify and close their new property. So the recording of this video, we're about mid-April. So from mid-April till the middle of August, 6 months, you have to now shop around to find that next property. It is inconceivable in that amount of time, if you're working with a broker who specializes in multifamily properties, understands the exchange process, is well versed with these types of transactions and assets. It's inconceivable that you cannot complete your exchange with that amount of time. Remember, this is a one-time extension that the government is offering to you. If you have contemplated a 1031 exchange in the past, and one of your main concerns that prevented you from going through the exchange was the timeline, this answers that. So if you have questions with regards to this extension, or you're simply curious as to what would a 1031 exchange mean to you, meaning if you were to sell and transition to a new property, how much would you see your income go up? How many more units would you add to your portfolio? What would that mean in potential tax deductions? I'm happy to walk through that analysis with you. That is a lot of the work that we do here at the Apartment Dealer, is walking investors through those exchange scenarios to see what is in their best interest. I hope all this information is helpful. Again, we're going to stay on top of the market for you. Don't forget, raisemyrents.com. You can go there now, get the rental rates in your area. We will update that once a quarter to ensure that you know exactly what's taking place in the rental market local to you. Chris German from the Apartment Dealer, as always, wishing you positive cash flow, tenants who behave, and much protection from Uncle Sam. Till next time.